From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, U.S. consumer sentiment recovers, rising for the first time in 5 months as traders position for next week's Federal Reserve rate decision with a cloud hanging over the idea of central bank independence. And big tech's debt binge threatens to swamp credit markets on both sides of the Atlantic. We begin with the big issue, the future of the Fed.
The underlying question is what the market expect the Fed to do versus what the Fed should do.
You can pick and choose whatever economic data you want to fit the narrative.
The Fed has a good read on what's happening in terms of the underlying momentum.
I really do think this should be a mixed decision right now.
Of course, they are going to cut because of all of this turmoil that they're in.
The bond market is sniffing out this idea that there is likely to be a dovish bias at the Fed.
I think the curve is going to steepen without a doubt.
So this volatility is here to stay, but it also creates very, very exciting opportunities for us in fixed income.
Because there's so much at stake going forward with the Fed changing.
The whole issue of Fed independence is definitely going to come back on the table next year.
We're a train here barreling towards a Kevin Hassett nomination.
The Fed is poised, regardless who's at the top, to see rate cuts continue.
For now, consumers are feeling better, perhaps on expectations of rate cuts. This top panel shows the University of Michigan's Consumer Sentiment Index improving in December for the first time since July. Now, to be sure, this is from fairly depressed level. In fact, the second lowest level on record. And this bottom panel here, the blue line, shows that a more optimistic outlook for personal finances helped bolster overall sentiment as consumers' inflation expectations have also improved. And when you look at the poly market odds, you can see that betting markets have turned more dovish. They reduced the likelihood of 2 rate cuts in 2026. That's the red arrow, the down red arrow here, while increasing their wagers on 4 to 5 cuts in 2026. Those are the green arrows going up. Overall, the odds are highest at 25% for 3 Fed rate cuts in 2026. Now, sticking with the Federal Reserve, Greg Peters of PGIM Fixed Income cast doubt over White House NEC Director Kevin Hassett, who is currently seen as the frontrunner to be the next Fed chair. Peters, who is a member of the Treasury Borrowing Advisory Committee, is skeptical that Hassett can deliver the rate cuts that President Trump is pushing for.
On one hand, you have the Fed independence question, with Hassett as, basically tied to the administration. But on the other, does he have the credibility within the committee to drive consensus? And so we don't know that answer. I don't think he has that credibility. I think that's what the bond market is telling you. You have to have the confidence of the committee to drive consensus, and I don't know if he has it.
Let's dig into all of this with our macro roundtable. We have Stephanie Roth. She is chief economist at Wolfe Research. And here on set with me is Collin Martin, head of fixed income research and strategy at Charles Schwab. Collin, let me start with you. Do you share Greg Peters' concern that a potential Fed chair, Kevin Hassett, may struggle to deliver all the rate cuts that Trump is pushing for, that he may not have the credibility with the committee?
We do share that view. When we look at the Fed chair, he's really just one person, and it's a whole committee that makes these choices. And when we look at the makeup right now, we understand that he's really just replacing Governor Miron, who's dovish himself. So we're losing one dove to gain another dove, and we don't think he necessarily has the pull. We also don't think the economic data supports the view right now that we're going to get those committee members, potential voters in 2026, that are leaning, I won't say hawkish, they're not expecting to hike rates or anything like that, but leaning against the need for an aggressive pace of rate cuts like those probabilities you were talking about before. Our outlook would change a little bit based on the Lisa Cook situation and then based on what Fed Chair Powell's plans are. He's been very tight-lipped about what he plans on doing. But if we were to get 3 more Kevin Hassetts or Kevin Hassett-like governors out there, then our outlook would change a little bit and we would expect to see a sharper pace of rate cuts. But for right now, we're in the cut next week and then probably 1 or 2 in 2026.
All right, it always comes down to personnel because personnel is policy, especially with this administration. So let's talk about the data right now, Stephanie. A rate cut next Wednesday is basically all but baked in. For policymakers, what is the takeaway from this week's offering of data, whether it's ADP and jobless claims or this morning's consumer inflation expectations expectations that would influence or most influence their forecast in the SEP?
Yeah, it seems so far like the SEP will probably be largely unchanged. The data this week is just another indication of that, in the sense that it's been incredibly mixed. We've gotten, claims that were quite low, and in fact, overly low. Our sense is that was probably driven by seasonality. Today's consumer spending data was disappointing, with negative revisions historically. When you zoom out, it looks like we're an economy that has certainly slowed down quite a bit this year. The labor market is in this low hire, low fire backdrop that doesn't appear to have changed. So the question is where we go from here, because we're kind of at this critical crossroads for the economy where things either have to stabilize and pick up, which is our view, or this deceleration just continues. We're not at an equilibrium where we can kind of stay in this slow growth environment. It kind of has to go in one of two directions. Our very much base case is that things will start to pick up as we get a lot of tailwinds heading into 2026.
All right, if things pick up, Collin, for the U.S. Treasury market, is it as simple as good economic news is bad news for the bond market?
Well, bad news if it means higher yields and lower prices. I think so. If you look at the way the curve is shaped right now, markets are expecting, I'd say 2 to 3 cuts over the next 12 months or so. So I think there's the potential for an upward surprise if we get that stronger than expected data. Now, our call right now is for the long end to kind of stay elevated. We saw the comments of a bunch of the clips you shared here. We kind of share the view about yield curve steepening next year. I think the two key drivers of the 10-year Treasury yield, probably hovering around 4% right now, is the sticky inflation we're seeing. We got the admittedly very delayed PCE report today. It was okay, but it still shows that inflation's still elevated. And then you have the supply issue.
Yeah.
Over time, we haven't seen much of a relationship between actual budget and deficit concerns and what that means in the here and now. But we don't expect that to change anytime soon. And when you couple that with what we expect to be a lot of corporate issuance and then even municipal bond issuance, we're going to see a lot of issuance next year, and we might need to see long-term yields kind of stay elevated to attract those marginal buyers.
Yeah, that corporate issuance is definitely going to be competing for investor cash next year. Stephanie, speaking of inflation, you look at commodity prices, and they have broken out of their 3-year range. In the past, what we've seen is a rise in the CRB index, and that's the blue line there, eventually lead to higher CPI on a global basis. That's the white line, with about a 9-month lag. Are there still global inflation pressures that are not fully priced into Treasury yields?
To some extent, although, of course, we have to remember that, yes, while headline inflation will be supported by higher commodity prices, core inflation is what matters for the Fed and for sort of the U.S. backdrop, in which case that is likely, well, maybe temporarily headed higher in the next, call it 3 months, and then it's likely headed lower throughout the course of 2026. I don't think there is that much global inflation sort of headed. Of course, this commodity sort of upward pressure has to work its way through, but I don't think we're talking about a big global reflation trade by any means.
Okay. I'm thinking also ahead to the BOJ, Collin. All of a sudden, there's now this prospect of a rate hike on December 19th by the Bank of Japan. This obviously has big implications for what Japanese investors do with their yen, maybe buy less treasuries, maybe even avoid treasuries. How are you thinking through the implications for global liquidity?
Well, global liquidity, I mean, that could be a big suck coming from the U.S. over to Japan if that were to materialize. But the idea of rising Japanese yields, it's just one more thing that we think can keep our yields elevated right now. We've seen that gap shrink. We've seen it shrink in a number of developed markets. And if the Fed does continue to cut rates in an environment where Japan hikes, and let's say the ECB's done, we're going to see those interest rate differentials continue to shrink a little bit. So we think that can pressure the dollar over the long term. We think it's an opportunity for investors. When we look across the U.S. domestic landscape, a lot of our clients at Schwab are probably underallocated to global bonds. And this year they've seen this really big bump because of the currency appreciation. If that were to continue, we think the dollar might kind of hold steady for a little bit. But if we see those shrinking differentials, that could result in local currency increases over time. We think this could be an opportunity to not go overweight or anything like that, but to introduce global bonds, given that their yields are well above levels we've seen for the past, say, 15 years or so, and you might get some additional currency appreciation.
Stephanie, let me come to you for the last question as we wrap up our macro roundtable here. What's the one thing that could surprise everyone from the Fed next week?
I think the thing that we're going to be watching for is in the statement. So the dots are kind of expected to be very little change, but what we're looking for is the messaging around future cuts. Is it going to be the timing and extent to which we get future cuts? Probably not. So the way that they signal how they're sort of thinking about the next couple of meetings will be a really important thing. So at times the statement is more or less important. This time that's going to be absolutely critical to gauge whether or not this is a hawkish cut or just a cut with data dependence as the focus.
Got it. Stephanie, really appreciate it. Stephanie Roth of Wolfe Research, and our thanks as well to Collin Martin of Charles Schwab. Now, coming up next, we've got the auction block. Big tech's debt binge threatening to swamp credit markets. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block. December may be a cold month for a large swath of the U.S., but debt sales, they're off to a hot start. This month is already lining up to be one of the busiest Decembers in recent years. This week's top deals featured Merck, ANZ, and GE Healthcare. There were more than 20 issuers. The $27 billion sold is the most for the first full week of December since going back to 2021. You see here, it has already surpassed the total amounts for the recent full months of December and is near the average for the past 8 years. While in high yield, steadily falling yields and tighter spreads crowded the market with 12 borrowers pricing more than $12 billion, marking the busiest week since September. Notable deals included Hilton, Post Holdings, and Venture Global. And sticking with credit, Apollo Global Management President Jim Zelter is using recent concerns about the overall economy and AI spending as an opportunity.
We like being in the middle of trying to pick the winners and losers because at the end of the day, that's just good credit picking. And I do think you're getting rewarded with base rates between 3 and 4%. And the clearing price for a lot of this CapEx for these data centers going to be more challenging. That's when you can actually earn your keep by being a smart investor. You're going to get more secular distressed than cyclical distressed. And that's very important. It's been a long time since we've had a credit cycle. We're gonna have a credit cycle. That's normal, it's natural, it's a cleansing process of capitalism.
Let's dive into the big issues in credit with our roundtable. Sonali Pier, Portfolio Manager of Multi-Sector Credit at Pimco, and Brad Rogoff, Global Head of Research at Barclays. And you heard Jim Zelter talk about, obviously, AI CapEx, and that's a big driver of credit issuance so far. But we want to talk about something a little more conventional, which is M&A, one of the biggest drivers of corporate debt issuance in general. And we got a big deal today. Netflix buying Warner Brothers for $72 billion. We see Warner Brothers Discovery bonds falling on the news. Meantime, Netflix is lining up a $59 billion bridge loan, which is usually replaced with corporate bonds. Sonali, let me go to you first. What kind of appetite do you anticipate for Netflix bonds? Is this something that Pimco would be interested in?
Thanks for having me, Scarlett. Good to see you. I think firstly, the fact that there is a pickup in M&A is highlighting the fact that we are seeing a bit more deregulation and therefore potential in more large-scale deals over time. But additionally, we're seeing a lot of potential for CapEx spend from AI. And so we do expect 2026 to see robust issuance. And at Pimco, we're really focused on identifying which of these credits are improving and doing that due diligence to make sure we're looking for the most attractive opportunities, especially as we see large-scale issuance potential across several asset classes in fixed income.
Absolutely. So, Brad, when you look at this Netflix potential corporate credit issuance, what kind of larger market impact would that have?
Okay, so you threw out a pretty big number, right?
Yeah.
But let's put it in the context of how much issuance occurs in the investment grade market. Let's stick to investment grade. So next year, we think there'll be about $1.6 trillion of investment grade issuance. So that's still a decent chunk of that, but really that's a gross number. And a lot of what happens is refinancing. That's going to have a smaller impact on markets than net issuance. What we've seen this year is actually net issuance has been down this year, close to 10%. With all the issuance you just mentioned, you did the December number, but It's been big all year, right? So if you've got negative net issuance this year, you've got something like Warner Brothers coming to market, or the funding for Warner Brothers from Netflix coming to market next year. Plus, you have all the AI issuance, right? And we'll see how much of that's in public markets versus private. We think you could see net issuance up something on the order of 40%, and that's supposed to have an impact on spreads, generically speaking, right?
How big of an impact could it have on spreads? That's the question, because a lot of people see maybe a modest widening when you've got a lot more supply coming.
Yeah, I think that's actually fair. Look, this year, there's been a lot of vol. There's plenty for you guys to talk about every day, right? But then if we look at spreads over the last 6 months, it is the lowest maximum spread we've seen over a 6-month period in decades for the investment grade market, right? And so vol, especially in April, but last 6 months, a lot less so. So look, there's a lot of money out there, right? Sonali and others have it, and I think they'll come in and find this paper attractive at a level. But could you get some cheapening up to the point where instead of we're talking about IG spreads around 80, we're talking about them around 90? I think something like that makes sense.
Sonali, does that match up to you? A huge influx in supply and spreads widening out maybe somewhat modestly? Won't issuers need to price this stuff more generously? Because there's a lot of unknown, especially when you're talking about debt tied to and issued by companies in a very fast-moving industry like technology.
Yeah, when we see significant amount of debt issuance, you generally do see some repricing. If we look back at when healthcare was a significant issuer, telecom in previous periods, we did see within investment grade a backup of, say, 30 basis points roughly of spread widening. Really, though, the important part is that selection, right? It's not that all of these companies are going to do well just from issuing and leaning into a secular theme. I think we really need to be, selective and doing that due diligence, and really whether they're coming to investment grade. That they have a bit more levers to pull to ensure resilience. But as we look lower in quality, high yield, bank loans, private credit, it's important to, we look at this as a public-private continuum. And the most important thing is that we're getting adequately compensated when we're giving up liquidity, going into more economically sensitive areas, and or adding on complexity in a deal. And so that diligence is going to be critical as we look at this additional supply.
When we talk about AI CapEx spending, there's an urgency now to hedge against potential AI bubble risk. And you can see that really embodied in the credit default swaps for Oracle, right? They're now at a 3-year high. Trading volume is up as well. Why is this the preferred vehicle? Does that make sense to you?
Look, if you look at the big hyperscalers and the big CapEx names, I mean, the one who has free cash flow that's lower than the others, and it could wind up being quite negative, is Oracle, right? And so if you had to pick one where people would focus, yeah, I understand why that answer is Oracle. Also, you just had a lot of issuance coming in Oracle, and therefore there was natural hedging demand. So sometimes what happens, just from a technical standpoint, is that builds upon itself, right? And it can be a little bit excessive at times too, but you do see from a free cash flow standpoint why people at least first focus on Oracle.
Sonali, what happens if Oracle gets downgraded to junk status? My colleague James Crombie on the credit team here says that Oracle would be about 10% of the entire high yield market, and we know a lot of funds have a ceiling sometimes of maybe 2% on individual names. How disruptive would that be, hypothetically speaking?
Yeah, this is absolutely, an important topic, because as you see investment grade issuers, firstly with long duration paper as well, which the high yield market's not used to, have potential for being downgraded. That can lead to volatility and significant opportunities. We've remained poised to really act on these opportunities, looking for those overshoots and identifying where there might be some more room to go. Importantly, when we look at our credits, we're really looking for those that have levers to pull to be resilient, and those where valuation is supportive. So I think certainly this would be difficult for the high yield market to digest a single capital structure from any of these hyperscalers or the like that are very large into high yield. But usually that also leads to opportunities, right? A pickup in volatility can sometimes actually shake up even higher quality opportunities, because sometimes investors need to sell what they can versus what they should. And that's really where we want to step in.
We know Bloomberg has been reporting that Morgan Stanley is sounding out investors on a significant risk transfer to offload some of its data center exposure, among other possible solutions it's considering. So, Sonali, I want to ask you, how are you hedging AI risk in your portfolio? With all the issuance this year and everything that's in the pipeline, in the works for 2026, data center AI exposure is only going to be a bigger part of everyone's portfolio, both in investment grade and high yield.
Yeah, this subsector is already 15% of investment grade and likely to grow from here. So it is definitely a large opportunity. And as we mentioned, we do expect additional financing in IG, high yield, the asset-based market, private credit, et cetera. So it is definitely a growing opportunity with risks and as well. And so when we look at this, we're looking for strong collateralization, strong deal documents, and appropriately priced. I think what's important here is there's no way around that due diligence. It's got to be strong because all issuers are not similar, and the monetization of AI is a big part of this discussion.
Right, but how do you hedge after the fact? What if you've already bought it and the due diligence worked out the first time, but you need to hedge it now?
I think that's exactly the point, right? In public markets, we have very strong liquidity, and it's only improved because of portfolio trading, electronic trading, ETFs, and the like. And so, we have that ability to be relatively nimble when opportunities change and, a thesis changes. We're underwriting with the expectation that we would like to hold this company over a reasonable time frame. But if that information changes, public market liquidity is stronger than it's been. It's really setting new highs, and that really provides us that opportunity to be active managers, look for that relative value, and change sales if needed.
Brad, final question to you. Do you worry about a deep-seek kind of moment, a competitor from out of nowhere who manages to produce the same stuff at half the cost?
I mean, it has to be your tail risk, right? We saw what happened in January, right? But that said, look where we've gotten to since then, right? And we've proven that wasn't quite as big a deal as maybe we all thought in January. And I think, the last thing I would say is with technology, that's what you do worry about. You worry about obsolescence risk eventually. Right. And to the point of Sonali's question, though, there are different ways to play this, which is either through regular way unsecured paper or specific secured paper.
All right, Brad Rogoff of Barclays and Sonali Pier of Pimco, thank you so much. This is Bloomberg. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. And the big event on the calendar, of course, is the Fed's rate decision. The meeting begins on Tuesday. We get the decision on Wednesday at 2 p.m. And right now you can see traders basically locking in a 25 basis point rate cut. The odds are now at 95%, although it's notable that volatility in trading for this has been pretty big. You, at one point in November, had 29% odds for that rate cut. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield. Keep it right here. This is Bloomberg.